Student loan rules just changed, and it affects millions of borrowers. In this video, I'll explain what changed, what it means for your payment, and what to do now. Change 1. Interest resumed on federal student loans on August 1st, 2025. What was the policy before this change? SAVE is the federal income-driven plan that used to stop unpaid interest from piling up when your required payment was zero. That protection ended after federal court injunctions blocked parts of SAVE. How did the government respond? The Department of Education resumed applying interest on August 1st, 2025 to comply with the injunctions, ending the 0% interest forbearance many SAVE borrowers were in. Change 2. Most income-driven repayment plans will be replaced by the Repayment Assistance Plan on July 1st, 2026. What was the policy prior to this change? Borrowers could choose from several income-driven plans: Save, Pay, Repay, IBR, and ICR. Payments were based on discretionary income, and forgiveness happened after 20 years for undergraduates or 25 years for graduates. What triggered the policy change? The One Big Beautiful Bill, a federal law passed in 2025, requires most income-driven plans to be replaced with a Repayment Assistance Plan. RAP bases your payment on adjusted gross income, or AGI. This is the income figure the IRS uses after certain allowable deductions are taken from your total earnings. For most borrowers, any remaining balance is forgiven only after 30 years of payments. Change 3. New lifetime borrowing caps begin on July 1st, 2026. What were the limits before the change? Undergraduate borrowing had fixed lifetime limits at $31,000 for dependent students and $57,500 for independent students. Graduate and Parent Plus borrowers could borrow up to the school's cost of attendance minus other aid, with no separate lifetime cap. What are the new borrowing lifetime limits? For undergraduates, nothing changes. The lifetime limits stay the same. For graduate loans, the new caps are $100,000 total for most programs and $200,000 total for law and medical degrees. Parent Plus loans are capped at $20,000 per year and $65,000 total per child. Now that you understand the major changes, let's talk about what to do with your student loans. Step 1. Call your loan servicer. Ask which repayment plan you're currently on, how much interest you're accruing, and what your payment is estimated to be under RAP. Clarify your recertification date and any deadlines you need to know before the transition. Step 2. Prepare for RAP payments. Starting July 1st, 2026, RAP will base payments on your entire adjusted gross income, from $10 a month at very low incomes to 10% of AGI above $100,000. Even the lowest earners must pay at least $10, and there will be no $0 payments. RAP cancels unpaid interest each month if you make the payment, and forgiveness comes after 30 years. Step 3. Lower your AGI if possible. Because your payment is based on AGI, contributing to a pre-tax 401k, traditional IRA, HSA, or other deductible accounts can directly reduce your monthly payment. Any questions? Drop it in the comments and I will reply.